Morning, Sean. How are you today?
Good morning. How are you?
Doing well.
Am I
You
the only
might
one
have
here
like the
today?
greatest one-on-one mentorship ever at the rate we're going, man.
Oh, what's going on? Did everyone quit?
Not to my knowledge. No, the schedule got a little wonky after the first week, obviously, and then I think people are mostly just confused now. But I know one guy, Rich, we may never see him because he joined late and he's in Australia. And this is like 4 a.m. for him. So he said he might try to get up early once or twice, but probably probably wasn't gonna make it. Oh, hey, so that reminds me, Rich, if you're watching this recording, we would love to get to know you. So please record a video introducing yourself. Tell us a little bit about your trading experience. You can just do it on your phone. It doesn't have to be fancy. Post it in the Slack channel for the group so that we can all kind of get to know you, learn a little bit about your journey, what your goals are, what you're looking to get out of this course or 2022 or whatever. And then let's see. As far as Alonso or San or Gustavo. Alonso and San were here week 1, so they may have just gotten thrown off by the week 2 schedule. Gustavo has had a little trouble with the schedule. So if you guys are watching the recording and you have questions or you're not sure what's up, shoot me a message and let's figure it out. But I'm going to pull up the notes and then we'll get started here because I want to stay on schedule. So.
Sanders looks like he's trying to get on.
Oh, perfect. Good. We'll have a little bit of a group discussion at least. All right, so today we are going to talk about debit spreads. Hello, San. Welcome.
Hey, good morning.
Hey, did you have a chance to watch the recording yesterday? I'm just curious.
Yes.
Oh, good. Okay.
I do have some questions.
Okay, we can start with those first in just a minute here. Let me. Okay, we got that. Let me pull up my charts and my broker here, and then we'll dive in. But yeah, go ahead, fire away with questions first of all, while I'm just getting set up at the last second here.
Sure. The three criteria you talked about regarding the liquidity.
Yes.
And you have the open interest volume and I guess bid ask kind of
The bid-ask spread.
Right.
Yeah.
Can we go through that like in it won't take too long, I guess, can we go through that again? I have question for each one.
Oh, okay. Yeah, we can review that because that's going to be part of the debit spread course as well.
Okay.
So yeah, we can cover that again, no problem. Let me see here. So we just barely. Wow. Okay. So we're up quite a bit, or we were up a bit, and now we've sold off. I'm just looking at the futures here. Let me open my broker, and then we'll dive in. How about you, Sean? Did you watch it again after after the deluge of information yesterday?
No,
Sean?
I had to run off to soccer for our team, and practice went long, and we have a tournament this weekend. So
Right, I remember you mentioning that. Yeah,
yeah,
I have to know how that turns out now.
yeah, we're I'll definitely share it. It's super exciting.
Yeah, no problem. All righty, let me just lock these in. Okay, and we will do this and this.
You're trading right now as we speak?
No, I am I'm booting up my broker. Sorry. I do not. I don't really trade during the groups. um, yeah, there's nothing I do that requires me to immediately stop in the middle of a class and do something about it. So
Right.
I try to give you guys my full attention while I'm here.
Appreciate that.
Okay, so let me share my screen. Yeah, sorry, Sean. I was just loading the broker. Sometimes it takes a minute. Uh, okay. All right. So I'm going to shoot a message to the other guys, tell them we're starting at least, and then we're just going to dive in. And
Robert, the one thing, if you could spend a few minutes on, is we went through it really quickly at the end,
yeah.
very end, is how to set up the credit spreads
Okay.
and the debit spreads, obviously, today. If the sell to open, buy to open orders, if you could walk me through that on Tastyworks, since we're using that,
Sure.
that would help me out.
Okay. No problem. It's extremely easy. So that will be no problem whatsoever. So
Thanks.
Alonzo, message Gustavo.
How are you, Sam?
You joining
Good,
us today.
Hey, Sean, you're doing well. I listened to you yesterday.
Thank you, sir. Thank you.
And we got San and Rich probably.
I was trying to ask questions to like help everybody at the same time as trying to help my own confusion. So, because I know a lot of people missed the class.
Okay. All right. So let's just do a quick recap on credit spreads. Okay. So basically, in terms of the key to setting up a credit spread correctly is to remember what the basic components are. All right. So you are basically, a credit spread is a way to sell a put or a call on a stock, but also buy your own insurance on it. All right. That's another way to think of a vertical spread. That's what we're doing here. There are all kinds of option spreads. There's diagonal spreads, there's calendar spreads. What we're dealing with is a vertical spread, which means that both of the legs expire in the same expiration cycle, and they're both made up of the same type of option. In other words, they're both puts or they're both calls. The distinction, of course, is that one is long and one is short. So, for example, if I wanted to sell puts on SPY here, but I wanted to do it in a way that would limit the buy power reduction or make it easier in an IRA. Let's say I wanted to sell a put at the 200. Okay, if I were to do that on SPY, that is about 440 right now. So if I wanted to do that on SPY, I could come in here, go to the 440, which is about the 32 delta. I'd actually probably go down to 437. Remember, I try to look for that 30 delta. If I were to do this right now, I could get paid $8.50 for it. The problem is, okay, even with margin, that's going to cost me $7,000 in buy power, right? So maybe you have the account size where that's not a concern. But if you're not in a margin account, if you're in an IRA account, it's going to be a cash secured put, which means that's a $42,000 buy power reduction, which is a bit pricey. So if you buy another put further out of the money, 1, 2, 3, 4, okay, then you can basically spread off the risk, which it takes it from a quote unquote undefined risk trade and it makes it a defined risk trade, which means this is the maximum amount you can lose. If this stock goes all the way down through here and blows all the way through the spread, and this spread goes fully in the money, you can never lose more money than this. Now, as far as exactly how to set that up on the put side there, Sean, in Tastyworks, what you're going to do is you're basically just going to click on the bid if you want to sell the option. All right. And it adds the leg in there. Okay. And then you can move it around. And if you don't like it, you right click it and you can delete the leg. So it's very interactive. All right. So you click on the bid and it sells the option. And then if you want to buy the other leg, you have to click on the ask. Okay, because
Okay.
if you're selling options, you want to talk to people who would want to buy options, which are the bidders, right? So if you're selling the option, you have to talk to the bidders. So that's why you would click on the bid to sell the put. And then to buy the put, you want to talk to the sellers, who are the askers, right? So if you want to do the long, if you want to do the long leg as insurance, you got to click on the ask. So that's really it. It throws the legs in there. You can move them around. You can move both of them around. All right. In Tastyworks, you can actually select both by clicking in the middle on the strikes, and then you can use these arrows down here, and you can move the whole spread together as one. All right, so these are just some basic Tastyworks things here. You can make the spread wider, okay, by clicking that button, or you can make the spread smaller by clicking that button. Right, so all of these are just kind of like little play with the software kind of things. Well, yeah.
Yeah, how to move both legs at the same time again? You put in the middle. What did you say?
Oh, okay. So yeah, if you want to move both legs together, you can move them individually by dragging them, okay, with your mouse.
That I know.
Okay, if you click it, see how it gets highlighted in blue?
Right.
Anything that's highlighted in blue will respond to these buttons down here in the trade window.
Okay.
So if you want to move them both together, you have to click them both so that they're both highlighted in blue.
Okay, no control key or anything.
No.
Just click. Okay.
Yep, you click them both so that they're both highlighted in blue. You will also see that they're both selected down here. Watch what happens if I unselect one. See, now it's darker while the other one is lighter.
Mm-hmm.
All right, so now that they're both selected, both of these legs will respond to any of these shortcut keys. So I can move the strikes down, and it will change the strikes together, or I can move them up and it will change the strikes together.
Okay. Good.
Yeah, cool little tricks there. So that's how the Tastyworks software works. Toss is a little bit different. You do have to control click to select them into a spread. So that's a little bit different. Each broker has its own kind of quirks, but the key is you want to the easiest way to, if you have to do it, I mean, some brokers have shortcuts too. Like if I go to this drop down menu here, see where it says vertical? That's the strategy we're using here. All right. And we're specifically looking at short verticals, which is another name for credit spreads. If you do it for puts, it's another name for bull put spread. All of those are the same trade. So if I do short put vertical, that's also bull put spread. That's also put credit spread. It's all the same thing. Okay. And if I just hit go, it throws it in there for me. Now, I don't like this setup, but at least it's a start. I've got a short put, then a long put. So I would probably want to make this $5 wide, and then I would want to move it down to the 30 delta. So that's another way to do it if you are in Tastyworks, okay? But the key is, again, to make sure that the short put or short call, because remember, you can do this. See, you can do this on either side, all right? So credit spreads can be bearish or bullish, depending on your bias, all right? So then we just throw this over here. I go down to the 30 delta, and I could try to do a short call spread on SPY here. If I wanted to get short on SPY, I could do this 474, 479, $5 wide credit spread and get paid $1.75, which, as you may or may not remember, is 1/3 the width of my strikes, so that's decent premium in my opinion. All right, so let's walk back through a little bit of the process for credit spreads. So you've picked a stock and you've picked a direction, theoretically. All right, let's say you want to go bearish on SPY. What you're going to do is make sure there's no earnings coming up, which obviously SPY is an ETF, so it wouldn't have earnings, right? Actually, let's do a stock just for the practice, okay? So let's find a stock here that is, it's got interesting IV. Intel's right at the top. There must be some news on them. They've got earnings in 7 days though, so I'm not going to do that. Let's do Trade Desk. All right,
your column that says LIQ, is that liquidity?
Yeah, that's Tastyworks. That's Tastyworks sort of
Definition.
meter and method for how liquid the stock is. The problem is it doesn't necessarily apply to the options. So I've looked at 4-star stocks before that had super liquid shares, but the options were kind of sus. That's why with this list I'm using the high options volume watch list up here in the selection box, because that sort of shortcuts liquidity for me personally. I actually trade off of this list all the time for that reason, because I almost never have liquidity problems off of this list. Now, sometimes if I find setups through other means, I have to check the liquidity myself, but just about anything on this list should be fine in terms of option liquidity, because that's what they're looking for. That's why they have this watch list. And all I did was sort it by IV rank to put the best options at the top. So just for the sake of review, let's go to the trade desk. Let's say let's just look at a chart. All right, let's pick a bias on trade desk. Do we want to go long or short here? Let me get rid of this crap because I'm actually not in this position anymore. I sold most of my directional pyramids last year around Thanksgiving and ended up just going neutral with mostly strangles. So let's see, we're crushing below the 200. We're putting in a decent hammer today, but man, it doesn't look good to me. The monthly's coming down to the 20 EMA. So maybe we're bouncing, I don't know. Weekly has some room to fall down to the 100, and then the daily, looks like death. We're kind of in a support area. If we don't bounce from here, this stock's in trouble. But let's say we wanted to go long. Let's say we have faith in that monthly support, okay? So we're gonna go long on the trade desk. So now that we've decided we're gonna go long on trade desk, all right, we've checked for binary events, okay? I did that actually on the watch list. Earnings is 29 days away, so that's fine. So the next step is to check the liquidity to Sand's point. All right. So remember, there was 3 liquidity checks: volume, which I have right here. Okay. Open interest, which I have right here. And then of course the bid ask spread, which is always, right at the money. So let's go through these one at a time, and then you can throw out your questions as they come. Extrinsic value, okay. And then we got to move on to debit spreads. All right, so let's start with open interest. What's the rule on open interest?
Over 1,000, but do you go by line, for example, you said like 1,000 in just one line of this table?
Yeah.
Just one
Yeah, as
line?
long as any line has at least 1,000, it's usually a pretty liquid trade. So in this case, none of the lines have 1,000, and we actually have some zeros out here now, way out here in the boonies, way outside of the money. That's not uncommon. It's not that unusual, especially since we're symmetrically have zeros over here. So nobody's really expecting this stock to make any outlier moves. But the fact that we don't have a single line in the calls or the puts that has 1,000 open interest on it is a little bit of a concern. I would say that's one red flag.
Okay,
Remember,
one red flag.
yeah, remember at 2 red flags, I'm kind of out. 1 red flag, I'll trade it, but I won't chase prices. I'll try to get fills at midpoint or within a nickel. But if I have to chase too much, I probably wouldn't trade that either, because again, we're doing multi-legged option strategies here. And next week, when we talk about the defense of how to manage a trade that is not working, because that is inevitable, okay, that's going to happen. It doesn't matter how high percentage win rate your strategy is, eventually you will face a situation where you have to defend a losing trade, okay? So when we get into the management techniques next week, you will see even more so why liquidity is so important, because with credit spreads, for example, I do a lot of rolling if I can. I try to take in more credits, reduce my cost basis, improve my profit targets and my break-even targets and all of that. So I'm in and out of legs within a position. And if the liquidity is bad, I'm going to get chalked up on the spread every time. And it removes my ability to potentially take small winners. Because if I try to take a small winner on a spread, but I got chopped up on that spread 3 or 4 times trying to defend it because the liquidity was bad, now I went from a small winner to a small loser. All right, so we got to be careful with the liquidity. So one red flag I would say is the open interest, because we do not have any lines with 1,000 open interest on it. All right, so let's talk about volume now. Do we have volume, and do we have volume at the money? All right, so what do you guys think? What is this? How does this look to you?
Not very much.
Yeah, zeros in the volume line are okay, because remember, these numbers are only for the day. Okay, so open interest applies to the life of the option contract. That's why I would really like to see, if I can, 1,000 there. Volume is only measured by the day, just like on a chart, right? Like if we look at this chart on Trade Desk, this volume bar here only applies to that day, okay, or whatever time frame you're looking at. So seeing zeros on volume is not necessarily a deal breaker. And I can see that there are some contracts being traded. I would say it's okay. I wouldn't say this is terrible volume. Terrible volume is literally like zeros at the money. Let's look at Amwell again and see what they look like. Just as for the sake of a bad example. Yeah, I mean, this is bad volume right here. Nobody's traded a single put contract on this stock all day long. That's the definition of this volume sucks. All right, so that's what you're trying to avoid. With this one, it's slightly on the thinner side, but I wouldn't say it's a fail. So I would say that the volume is like, not bad. You know, it's like we can work with it. All right. So let's look at the bid-ask spread now. What was the rule for the bid-ask spread?
10%.
10%.
Off of the ask. Okay, so the ask is $7.35, which means we need to subtract 73 cents from that number. And I'll just do the math on the calculator so we can all clearly follow along. So 735
times 0.9.
735. Yeah, that works. I just tend to do the minus 10%. I'm not really sure why. So 662 is the minimum bid that I would accept, because that's going to be 10% away from the ask. So do you guys kind of follow that calculation? Right.
Yeah.
So because the bid is $7.05, it's higher than the minimum of the 10% rule, which means that also checks out, right? So the bid ask spread looks okay. So I would say that the liquidity on this stock is not the best, but it's okay. It's tradable. So I'd have no problem putting a trade on in here. All right. So we already decided we want to go long because we're at monthly support. All right. The liquidity is workable. All right. So we checked that. So now we need to make sure that the IV is good, which it is. Obviously, it was on that list. That's why I found it. The IV is 92.9. Remember, what you're really looking for is something over 30. Well, anything over 30 really is great. All right. If you are between 20 and 30, okay. If you are between 20 and 30, it's kind of like, maybe. All right. You're going to check the premium by seeing what you can get for the spread width. I have traded credit spreads on IV as low as like 25 or so, something like that. But it's not very often that I do that. And I typically don't do that when I typically only do that when the VIX is really low. We're in a boring trending market and there's just no volatility anywhere. All right. Typically, though, over 30 is what you're looking for. And then, of course, if you are at if you're under 20, that is a no-go for selling options. Now, after this review, we're going to talk about a debit spread, which is the tool you use when IV is under 20. All right, so I'm going to give you guys something to trade in every environment. You'll be able to pick a stock, pick a direction, and as long as the options are liquid, It doesn't matter what the IV is, because you can use either a credit spread or a debit spread, and you can take a trade on it, okay? But right now we're reviewing credit spreads, so you're looking for IV above 30, above 20 if you can, all right? But anything below 20 is debit spread territory, all right? So don't sell options below 20 on the IV rank. So anyway, this one checks out, all right? So the next step then, we're going to choose.
A quick question.
Yeah.
For the bid ask spread, you only look at the ATM. At the ATM.
Yeah, that's where the current best action's going to be.
Okay.
Sometimes way out here in these outlier strikes, the spreads get wide because nobody's trading out there. But that doesn't mean that you can't get a decent fill at the 30 delta. Like, look at this guy right here, okay?
I'm just saying, like for the checking of the liquidity point of view.
Yeah, I only look at the money.
Okay. Yeah.
Yeah.
And for the volume, would you also pay more attention to the at the money volume?
Yep.
Okay.
I'm not super concerned about zeros out here on the volume line, because this is the 95 delta. There's very few people trading out there, so that's not surprising.
All right.
The only major liquidity concern I have with Trade Desk is the fact that there's not 1,000 open interest on any one line. But the other two checks are okay, which means that I would potentially be allowed to trade here if I wanted to. I just probably wouldn't chase too far. You know, when I don't know how many spreads you guys have traded, but sometimes when you put spreads in, you submit them at mid price, they don't fill. All right, so what I'll do is I'll adjust them by a few pennies. If they still don't fill, I might adjust them by a few more pennies. If it's a super liquid stock, I will do that until I get a fill. But in a situation like this, where there's a little bit of the concern about liquidity, I'd probably only do that until I were 5, maybe like 8 cents away from the mid price. And if I can't get a fill at that point immediately, I'm done. All right. So I don't necessarily just let orders sit for long periods of time because of the way the options market works. Okay. I'm not sure if you guys are aware of this. This is a little bit of a tangent, but there are major firms and companies, Google, Citadel, for example, whose sole purpose and for existence is to provide liquidity to the marketplace. So they are going in and taking the other side of your option trade. All right, I once had a financial planner tell me that trading options was a poor way to invest or make a living unless I were a genius MIT graduate. He said it's a zero-sum game. He said somebody smarter and better with more resources is taking the other side of your trade, and you're just going to lose. And that was very deflating to me early on in my career. And then I found out later he's actually a moron who doesn't know what he's talking about. If you guys think of it, it logically makes sense. If you fill a decent trade in a liquid stock, how long does that fill actually take with options if you send it at mid price? In your experience? Yeah, it's almost instantaneous. There's no bleeping way there's a human being on the other end of that trade. No way. They cannot evaluate it that quickly, right? They can't make that decision. That means there's a computer on the other side of your trade. And it's a computer that is run by companies like Citadel, who exist to do nothing but provide liquidity in the marketplace. So what they do is they accumulate all these trades, right? Oh, you want to trade? I'll take it. You want to trade? I'll take it. You want to trade? You want to trade? I'll take it. I'll take it. I'll take it. And so at the end of the day, they have all of these positions that they didn't want. Their customers wanted them. And it's called a negative selection portfolio. This is a little bit getting into the weeds here, but the point is then they'll go off and buy stock and balance their delta. They'll be fine. They make their money on just selling, making little pennies here and there. They're the market makers. They provide liquidity. So the point is, if the stock is not very liquid, it won't fill immediately. And you don't want to pay the market maker to get into your trade. So if I submit a mid-price order and it doesn't immediately fill, sometimes I'll adjust by a few pennies, okay, which is fine. All right, that's how they make their money, and a few pennies is not going to hurt me much in the long run when I'm shooting for 50% GTC orders. But if I have to wait, if I go more than like a nickel or even a dime away from the mid price and it still won't immediately fill, I'll just move on and trade something else because that means that there's just not enough liquidity there. Any more questions on liquidity? No? Okay, cool. All right, so at this point, the next step is to pick an expiration cycle. Do you guys remember what we do with the expiration cycles? What's the range? What's the optimal range for
45 to 60 days.
Exactly. 45, ooh, man. 45 to 60 days. All right. Now, this is not my rule.
It's not.
This is a rule that has been researched and back tested by actual MIT geniuses. All right, so what does that mean? All right, let's look at these. Choices. Oh, the other thing too, don't forget, I tend to trade monthly cycles because again, the liquidity is going to be better. All right, I'll show you guys an example. Let's just go look at SPY for a minute. All right, I told you this was the most liquid ticker in the entire stock market, which is pretty much always the case. All right, we look at the monthly March expiration cycle on SPY. You can see hundreds, even thousands of contracts have been traded today alone on the volume line. All right. The other thing you can see is that we have thousands and tens of thousands of open interest contracts on the open interest line, right? And the spreads are 2 or 3 pennies wide. Crazy good liquidity. But if we just go to the weekly cycle, all right, let's back up a couple of weeks and go to the weekly cycle. It's still fairly liquid, but it's a different picture, isn't it? Now, all of a sudden, we have a few hundred on the volume line, which is fine, but we actually only have one line of 1,000 here on this SPY expiration cycle. This is SPY. You know, everybody's trading this, but not on the weekly cycles. All right, so you have to be very, very careful about weekly cycles. I personally, okay, only use weekly cycles when I'm defending a trade and I need to get a roll, and a weekly cycle is the only one that gives me a credit to do it. All right. The rest of the time, I tend to just stick to the monthlies. It makes management easier and you're going to get better liquidity there.
Okay.
Me personally. Okay. The main thing I use weekly options for, honestly, is day trading, which is a totally different, not math-based concept at all.
Did you notice any kind of like a premium kind of difference between weekly and monthly?
No, that's going to depend on the IV. For yesterday, I was mentioning that
No, IV is the same, right? They're the same.
the IV rank may be the same, but I was mentioning yesterday as I was discussing the concept of implied volatility, each expiration cycle has its own IV, which you can always see over here on the right-hand side.
Right.
Okay.
They are what I'm saying is they are mostly the same, kind of like if you check it, right? They're
going to be
about the same.
close, okay? Obviously, one's going to be a little bit more than the other because one's going to have more extrinsic value. All right, if I sell the January 28th weekly, there's going to be very little extrinsic value in here because there's very little time left. There's only 9 days. If I sell the 44 days out March 4th weekly, this has a lot more extrinsic value in it, so there's going to be more premium just because there's more extrinsic value.
Okay.
Yeah. All right. So 45 to 60 days here means that this March expiration at 58 days is right in the wheelhouse. That's right where we want to be. So if I were putting new trades on right now, it would be in March. All right. So we talked about the strikes. I usually go right to the 30 delta. All right. That doesn't mean I'm going to stay there, but that's where I'm going to start. Okay. So I have a $5 wide spread. All right. So in order to set that up, remember, I'm going to click the bid for the short leg. And then I'm going to click the ask for the long leg. All right, so that gives me a $5 wide spread. I'm getting $1.59 for this in premium right now. Do we like that or no?
Yeah, that's within the wheelhouse.
$1.67, right? That's what you're looking for.
Yeah, I mean, we're looking for 1/3 the width of the strikes.
Yeah, so that is $1.50, 67 cents.
$1.65 is, but yeah, pretty close.
Okay.
Typically $1.65 is like my cutoff for a $5 widespread. So this is a little bit under. Now, if I really liked the chart, I might trade this anyway. All right. So that's, you can be a little bit flexible with that. You really want to be as close to 1/3 of the width of the strikes as you can. I don't personally use it as a pass fail rule, but I probably would want to make sure I get over $1.60. Okay, but again, the problem is the IV rank on Trade Desk is really, really high. Welcome, Alonzo. Thanks for joining us. The IV rank on Trade Desk is really, really high. So if I am not getting 1/3 of the width of the strikes at the 32 delta, despite really high IV, it's not ideal. If I what I like to do is I like to look for 2 or 3 trades and then pick the best one. If I saw this trade, I'd probably go and try to find a different trade. But if this were the only trade available to me and I had buy power and I liked the chart, I've traded $5 wide spreads for $1.60 before. It's not great, but you know, sometimes there may not be much volatility out there. It depends on market conditions. Market conditions right now are such that I feel like we could find a better trade if we wanted. All right. So I'm not going to take the time to do that because we do need to move on. I want to get the debit spread lesson done. I want to get it recorded. And then you guys can watch both sessions again all week long, and we can ask questions in Slack and have a dialogue there about what's going on. Okay. So that's basically how a review of how to set up a credit spread. You can, as I said, you can definitely do it to the call side as well. All right. Let's say you didn't like the chart on Trade Desk and you wanted to go short. This is the 29 delta, which is a little bit less than the 30. And I'm only getting 87 cents for a $5 wide spread. So there's no premium to the downside on Trade Desk right now. Everybody expects this thing to go down. All right, you'd have to really get close to the money to get paid on this. So I wouldn't be able to do a credit spread in here. If I were going to do Trade Desk and I wanted to short it, I'd have to do a debit spread. All right, so let's talk about last piece. After we place the credit spread, let's say you place the order, it's sitting in your position tab, it's ready to go, it's working, it's in the market, you filled the trade. What's the last thing you do before you move on to something else?
Order.
GTC order to close. Correct. Yep, GTC order to close. All right, so you just right click the position in Tastyworks. In this demo account, I don't really have any open positions to manage, but you just right click the position and a little screen will come up that says like, you know, roll or close or whatever, and you close you select close. It'll bring up the trade page. So it would look something like this. All right. And then you would change the time in force, all right, which is something that every broker has. So you should be able to do this in any broker. You're going to change the time in force to GTC. All right. If you're closing a credit spread, you have to buy it back. So that means this time you're going to pay a debit. And you would set it for 50% of the credit you received. So if you sold it earlier, we were getting $1.62. So if you actually sold it for $1.62, you would want to close it for 81 cents. That's 50% of the credit you received. And then you hit review and send and wait for that to happen, essentially. Any questions on credit spread review? All right, let's dive into debit spreads. Now, the good news is this lesson should go a little bit faster, okay, because we've already talked about IV rank. We've already talked about liquidity. So we're basically going to skip over all of that and jump right to how to set up the debit spread and what makes debit spread different. All right.
So, by the way, Robert, I
yes,
may
sir.
need to drop at 10 o'clock. So just letting you know.
In 20 minutes?
Yes.
Okay. All right.
And by the way, can we get this like this like your strategy in electronics format? This right
Yeah,
here.
you know what? I apologize. I should have sent the Word doc from yesterday's notes out. That goes along with the video, so I will do that here as well.
Thank you. I was going to ask that.
Yeah, no, that's my fault. That's supposed to go. I was in such a hurry to get the recording out that I forgot to send the notes. So when I post the recording for the debit spreads today, I'll send the notes for yesterday and today. So you'll get this sheet right here.
Okay.
Yeah,
Thank you so
sorry
much.
about that. I always send that out and I had forgotten yesterday. So thank you for the reminder. Okay. All right. So now we're going to take everything we just learned, guys, and we're going to flip it on its head. All right. Because now it's time to trade debit spreads. I'm curious, of the three of you, and Alonzo, you can chime in here as well now that you're here. How many of you have ever traded a debit spread before?
Yeah.
Okay. All right. Both of you have. Great. Okay. Have you traded debit spreads, Alonzo?
Yes, I have.
Oh, perfect. All right. Well, you guys are pros. All right. I'm going to show you how I trade
Not a
debit
pro.
spreads then. Not a pro. Well, we're going to make you a pro. Okay. We're going to get you there, Sean. All right. So the key difference to start is that debit spreads are a low IV trade. All right. So when we were talking about credit spreads yesterday and we're talking about selling options, we wanted lots of volatility. We're going to sell high and buy low. Well, now we have to have something to do when there's no volatility, because there's not always going to be volatility. You know, if you guys look at a chart of the VIX, all right, this thing tends to live at pretty low levels. And then every now and then you'll get lucky and it'll kind of pop up, but then it goes right back down. And then it'll pop up and go right back down. Pop up, go right back down. This is why selling options works so well. Because if you sell up here, the odds are you're going to be able to buy it back down here for a profit, because the VIX is very, very consistent. All right, but we still need something to do. If some beautiful chart drops out of the heavens and is gifted to you from the stock market gods, and you have to get into a trade, but the IV rank is low, the best way to do it in a math-based way is to trade a debit spread. All right, so this is anything with an IV rank below 20. I have traded debit spreads when IV rank is above 20 before, but only in situations where a credit spread doesn't meet the premium requirements. All right, so let me just be very clear about this up front. Credit spreads win more often than debit spreads because of the way options work. Remember, options tend to be overpriced, which means the edge, the advantage, is almost always with the seller of the option, not the buyer of the option. So if you have the ability to sell an option instead of buying an option, you're always more likely to win on the sell the option trade. However, when there's no volatility, you kind of negate that advantage to a point where it doesn't make sense to necessarily sell a credit spread, because the probabilities, the statistics are that you're headed for an expansion of IV, not a contraction. All right, so the tool in the toolbox for low IV environments is the debit spread. Now, again, this is a debit spread vertical. All right, there are debit spreads that have all kinds of different shapes. All right, but for a vertical debit spread, what that means is both legs of the option are the same. It means they're all calls or they're all puts, and they're all in the same expiration cycle. Okay, one option is stacked on top of another. That's why it's called a vertical. Now, we'll get into the setup here in a second. I just want to get through some of the notes here. Check for binary events. This is exactly like the credit spread check. All right, look for earnings is basically what that means. I do tend to go light through presidential elections just because those can also be extremely volatile. As Sean was mentioning yesterday, we discussed Fed meetings. There's way too many of those in a year to try to trade around those, because sometimes these trades take a week or two to play out. So I do not worry about Fed meetings, but I avoid earnings. I avoid presidential elections. Sometimes I mean like big elections, the every 2 years ones, honestly. I tend to lighten up. I may not be completely out, but I'll be lighter. I just, there's rarely, you don't really know how it's going to go. Anyway, so
So
that's what I'm,
about the binary events,
yeah,
for the earnings, right? So
yeah,
when we are selling the spread and we want to avoid the binary,
yeah.
the earnings.
Mhm.
So on the flip side, can we consider to actually deliberately buy when the earnings event, is coming up? So should we consider that kind of strategy where you're expecting some earnings will kind of like boost it up or something?
You can. I don't trade that way because that's not really based in probabilities and statistics. That's based on something else. I have not personally encountered a method for accurately determining the outcome of earnings. Most of the time, earnings tends to be a crapshoot. I've seen good earnings gap down. I've seen bad earnings gap up. I've seen people expect good earnings and get bad earnings and buy anyway. It's just a very, very uncontrollable, unknowable event in my experience. So I don't trade. I know people who will sometimes buy options hoping for a run up into earnings and an expansion of IV and all of that. That is a different strategy. It's not a math-based strategy, so that's not usually what I do. But it can work. If the chart is strong and you think it's going to run up into earnings, you want to take advantage of the vol expansion. Uh, that is a different style of trading around earnings. But for the purposes of consistent, statistically probability-based returns in math-based option trading, the goal is to avoid outlier moves, which is typically what happens in earnings cycles.
Okay.
Cool. All right. So we already discussed liquidity quite a bit, so I'm just going to skip that. The checks are all the same. It's identical. Check the volume, the open interest, and the bid-ask spread. Okay. Just like the credit spreads, we want good liquid options to work with. And guess what? The expiration cycle, it's exactly the same, 45 to 60 days. Why is that? All right. So what I'm going to do here for you today is show you how to trade debit spreads in a way that is still advantageous. So I've talked already quite a bit about the fact that buying options is a disadvantaged game. All right, if you just buy a call at the money, you have a 35% chance of making money on that. All right, so it's already a losing trade when you put it on, which means your charting had better be perfect. Your technical analysis had better be flawless because you're fighting the Greeks, you're fighting the extrinsic value, you're fighting the theta, you're fighting all of those option factors that make option trading harder than stock trading. So what I'm going to do is I'm going to set a spread up in such a way that I can still take advantage of those things and yet pay for the spread because it's low IV. And so in order to do that, we have to stay in the same expiration cycle, that 45 to 60 day curve as theta starts to really decay. All right, we want a positive theta trade. You guys are going to hear me say that a lot, especially in 2 weeks when we get into the diagonal spreads as it gets even more mind-bending. All right, positive theta. Remember I talked about theta in the first week. All right, that is the rate at which extrinsic value drains out of the option. How fast is that option losing its time value? Every option contract has a certain amount of time value built in. That's the extrinsic value that represents the length of time that you're paying for in that contract. How fast does that time drain out of the option? That is measured by theta. If you have positive theta, it means that that time is your friend, not your enemy. If your trade shifts to a point where you have negative theta, that means that theta is starting to eat away at your trade and you need to do something. All right, so even for debit spreads, we're still going to stay in this 45 to 60 day cycle. And now let's talk about setting up the spread. All right, so I'm going to just jump into the option chain for this part. You'll have the notes. I'll send them to you, so you'll have the reminders right here. But it's easier if you see it. Okay, so let's find a trade let's find a trade that has liquid options, but maybe has low IV rank that we might want to trade. Macy's. What's Macy's doing? I've traded Macy's before. I've actually traded. Did you guys follow the weekly options newsletters when I wrote them last fall?
I wasn't.
No? Okay. We actually did a debit spread trade on Macy's. That's kind of funny. All right, so let's look at Macy's here. All right, so let's see. We're under the 100 on a daily right now. All right, we've got a pivot here under this hammer and another pivot down there. So not real strong daily support, I would say. Weekly, we're sitting right on the 20. That looks good. Let's see. Monthly, we're just kind of going sideways, honestly. Look, you know, the moving averages are starting to converge. So this isn't the greatest trade I've ever seen, but the IV rank is low, so it'll serve our purposes as far as being a good example for now. And I know Macy's is liquid because I've traded it before. Okay, so let's take a look here. When I am setting up a debit spread, I will typically start with the short strike. All right, so a debit spread is going to be different. If I were selling a credit spread, I want the short strike to be close to the money, and I want the long strike to be further away from the money. All right, this is your standard operating credit spread. For a debit spread, it just has to be the reverse. But we're going to go slightly in the money this time. All right, we're going to put the long strike in the money, and we're going to put the short strike out of the money. All right, so notice now the order type is debit, not credit. Okay, so we just basically flipped it upside down. Everybody see that? All right.
Yeah.
Now, the first thing I will do, this trade right here is why I have the extrinsic value on my option chain. Well, it's one of the reasons why. One of the key tricks to trading debit spreads in a math-based way is that you can still pay for the option spread while selling more extrinsic value than you are buying. All right, so what I will typically do is I will start with the short strike on the line that has the most extrinsic value, which is always usually right at the money, guys. Okay, so if you look at this extrinsic value column here, you'll see as soon as my mouse wheel scrolls, way up here, there's virtually no extrinsic value because that's virtually like stock up there. All right, there's almost no chance that thing goes out of the money. But as you get closer to the money, the numbers get bigger. All right, there's much more extrinsic value here right at the money. And then the pattern repeats. It starts to get smaller the further away from the money you go because there's almost no chance these options down here actually expire in the money. All right, so the extrinsic value has to do with the potential moneyness of the option as much as it has to do with time value. So 233 is the most extrinsic value on the column. Can you all see that?
Yes.
So I want to sell that because, again, my goal is to sell more extrinsic value than I'm buying. This is a debit spread. I'm going to pay money to buy this spread. But if I can sell more extrinsic value than I'm buying, I can have a math-based advantage while still buying an option. All right, so I am not the kind of guy who will put a debit spread way out here and hope for the best. The probability of profit on this trade right here is 8%, because the likelihood is that this whole spread's just going to die and expire worthless. I want to be a seller of options out there. When I'm buying options, I want to be at or in the money. Okay, so this time, this is where I'm going to start, but we got some more things to look for, all right? I check 3 things, and they're in your notes. I want positive theta, I want more extrinsic value than I'm buying, and I want a pop that's around 50%. I'm going to put around because I fudge this sometimes. This one I'm a little bit flexible on. Can be a bit flexible here.
What do you mean by that one? Pop around 50%.
Yeah, that's going to be a Tastyworks metric. We'll look at that here in a second.
Yeah.
All right, so let's just
Probability of prevailing.
probability of profit. Yeah, I mentioned it in the credit spread video yesterday, but it's this
Oh.
right here.
Oh, okay.
If you want to check this in TOS, you have to use the Analyze tool, okay? So you can check that in TOS. It's in there. You have to use the Analyze tool, go to Risk Profile. But it's more complicated. Tastyworks is nice because it puts it right there on the trade page for you. So, as I was saying, I want positive extrinsic value. Now, if you don't have extrinsic value right on your trade page, because I think Tastyworks is the only one that does, you can do the math. All right, look at your option strikes. Notice how the short strike has has $1.89 extrinsic value, and the long strike has $1.07 extrinsic value. As long as this one is bigger, you're good. That's what you're looking for. This one must be bigger.
Hey, Robert, in that case, like if you are trying to sell at the most extrinsic value, so why not move it to $25 or something for the sell leg?
Well, well, we'll get to that. Hold on to that. I think that will become apparent to you in a moment. Okay? We have to strike a balance because remember, as we're buying options, we want to buy low, sell high. The further in the money you go, the more expensive the spread gets. So you have to strike a balance. All I want to do here is make sure that I'm getting some kind of positive extrinsic value and that I'm getting positive theta, which again, you have to use the Analyze tool in TOS to check that. But that's what I'm looking for. Theta, extrinsic value, and a pop around 50. 49 is fine. I've traded as low as 48, 47. Anything lower than that's kind of like, I could probably find a better trade. So those are the main three things I look for in a debit spread, okay? Now, there's one last thing I always check, all right? This is a $5 wide spread. So I check the premium just like I would on a credit spread, only this time I want to get it as cheaply as possible. All right, so the price matters. If we look at the notes here, what I'm really going for, I try to pay 50% of the width of the spread or less. All right, that's important. If I can, all right? My line in the sand is usually 3/5 the width of the spread. So I do not pay $3 for a $5 wide spread. I do not pay $6 for a $10 wide spread, etc. But ideally, I'd like to pay half or less. All right. So for a $5 wide spread, what's half the spread?
$2.50.
Yeah.
$2.50. It's
$2.50, which means this is a touch pricey, but not necessarily impossible. $3 up for a $5 wide spread is the end. I don't do that. That's my 3/5 cutoff rule, right? So here's how I set up my debit spreads, guys. I start with the short strike on the line that has the most extrinsic value, and then I move the spread out of the money as far as I can while still getting positive extrinsic value and positive theta. And as long as the price at that point is under or around half, it's a good trade in my opinion. 45 is a little low on the pop, to be honest. I might actually just go ahead and do this trade, even though it's a touch more expensive. But you could honestly do either one. All right, so that is how I set up debit spreads. Remember, the keys are positive theta, positive extrinsic value, pop around 50, and you're looking to get close to half the width of the strikes or less as a price, because we want to buy low and then sell high. When I close this spread, I have to sell it back because this is a debit spread now. It's not a credit spread anymore. This one is a debit spread, which means I'm paying for it. So when I'm done and I want to close this trade, I have to sell it back. So the goal obviously is to sell it for more money than I paid for it and make a profit, right?
Mhm.
Questions on setting up a debit spread? What do you guys got?
So, I mean, just in the big picture of things, what you're saying is you're buying low, selling high, so you're bullish on the stock.
Not necessarily, Sean. Options allow you to do just about anything. If I didn't like that chart and I wanted to go bearish, I would just move it over here and buy a put debit spread.
So do you expect the IV rank to go higher to be profitable in this case?
Well, yes. That's why this is a low IV trade. Okay. IV rank under 20 means that we have a statistical likelihood of having an expansion in volatility, not a contraction. However, it's not the only factor. All right. I talked about this yesterday in the credit spread lesson, but direction still matters, right? If you sell a put, or excuse me, if you buy a put, and the IV rank is 90, but the stock goes down, are you going to make money on your put? Yes or no?
If the IV rank is 90,
If the IV rank is 90 and you buy a put and the stock tanks, are you going to make money on your long put?
yeah, because it's going down.
Of course, yes, you're going to make money. Would you make more money if you did that in a low IV environment, and in addition to the stock going down, there was also a massive expansion of volatility, raising option prices across the board? Would you make even more money in that situation?
Yeah, because there's more people liquidating their assets.
Absolutely. So IV rank is about optimizing the statistics and the profits, but it's not necessarily the only thing that matters in whether you win or lose. Direction is still the main thing that will determine whether you win or lose. If I buy a bear put spread here and Macy's goes straight up to the moon, I'm losing on this trade. There's no there's no ifs, ands, or buts about it. It doesn't matter what the IV rank is. If Macy's goes straight up from here and this spread ends up closing fully out of the money, it'll go to zero and all this money I paid for it will disappear. So direction is still important, but by using IV rank correctly, you can increase the odds that you can win on the trade. And especially when it comes to credit spreads, guys, you can actually be slightly wrong and still make money. So that's where leveraging IV correctly makes a huge difference. If I have a stock and I have a bias and I can use a low IV instrument or a high IV instrument and still trade the same stock, bullish or bearish, depending on what I want to do, why would I not try to put IV rank on my side as an advantage? I would, right?
Yeah.
Yeah.
It's just another tool in the toolbox to verify which direction.
That's it, man. That's it. Another tool in the toolbox. All right, so let's get through the rest of the notes here. Excuse me. The position sizing stays the same, okay? So we talked about position sizing yesterday with credit spreads because we don't have an R for option spread trading. All right, so typically what you're going to do is stick to the 3 to 5% rule of your account. All right, so if you have a $100,000 account, you're going to trade about $3,000 up to $5,000, depending on how the trade works out. So if I were to, excuse me, let's go back to the calls here. If I were to, let's say I wanted to go long on Macy's and I were to buy this $2.36, $5 wide bull call spread on Macy's. This is a bullish trade. okay, because I'm buying a call spread. If I were to do this and I had a $100,000 account, 3% is $3,000. I would do enough contracts to get the buy power reduction to be about $3,000, between $3,000 and $5,000, right? So I'd probably buy 13 of these. Now, I mentioned this yesterday in the credit spread room. If you have a $10,000 account, well, guess what? $300 is 3%. So you're really only going to do probably 1 or 2 of these. You could do 2 because that would be under 5%, but you could do 1 or 2 depending on what you wanted to do. While you guys are learning, just stick to one contract no matter what your account size is. All right, because you don't want to be scared of taking catastrophic losses, because if you mess something up, it could go poorly for you, right? So while you're learning and you're practicing, I would just stick to one contract. But eventually, as you get more comfortable doing this and you get more comfortable trading options this way, 3 to 5% is about right.
So if in this case, if the stock doesn't move, right, just stay at $25 or something, will you make money?
It's a good question. So on a debit spread, typically, oh boy, I don't remember the calculation for that. I'd have to go into the curve mode and see. Let's find out. Analysis. If Macy's stays at $25, no, you will not make money, because you still are paying a premium to be in the trade. Your break even is technically, according to this, 25.41, I think. Yeah, something like that. There is a formula for it. I'll look it up. I think it is your short strike plus the premium. So that'd be 25.36, technically speaking, I think is what your, if I'm not mistaken, I think that's the calculation. So or I'm sorry, your long strike. So you take the long strike and you add the premium you're paying to that. Okay, so 23 plus $2.36 is $25.36, and that should be the break even. So Macy's has to close above $25.36 for you to be profitable by 1 penny at expiration, which is actually right where it's at. If Macy's sat right here, you'd be fine. If Macy's drops down to $25, you're going to lose probably 20 cents.
Okay.
Yeah, but you're trying to close this out, way before the expiration, right?
That is correct.
You're closing this out once you're profitable. Once it hits 28, you're out.
Well, maybe. There's a different metric. It's actually 35% of the debit of the max profit. So now this formula gets a little bit confusing, so we're actually going to talk more about it next week. Next week is where we're going to talk about how to manage these trades. All right, the target on debit spreads is different. All right, so for credit spreads, the target is 50% of max profit. All right, which is also 50% of the credit received. But in debit spreads, remember, we're paying a premium. So your target is actually 35% of max profit, because debit spreads tend to move a little bit more slowly. They're a little bit more lower probability, but the max profit gets a little bit tricky on a debit spread. All right, because what's interesting about defined risk spreads is they can never be worth more than their own width. A $5 wide spread can never be worth more than $5. If you buy a $5 wide spread, you cannot sell it for $6 or $7. It's impossible. Some brokers won't even let you ship the order. Same with a $10 wide spread. It'll never be worth more than $10. I don't care how deep in the money it is. That is a $10 wide spread, and that's it. If you pay $9 for a $10 wide spread, you only have $1 to make money, right? So because of that, it creates this either or situation where we have our risk on one side and our profit on the other. All right. Out of the $5 wide spread, we paid $2.36. When you buy a debit spread, whatever you pay is also your max loss. Because if the spread goes to zero, you just lose what you paid for it, and that's it. So the maximum loss on a debit spread is the same as what you pay for it. The max profit is the other side. All right. So $5 minus your debit paid equals your max profit, which in this case is $2.64. And this right here.
Yeah. So I need to drop now. Very cool.
Okay.
Very cool. Thank you.
Yeah, we're actually close to wrapping up, San. So catch the end of the recording, and then we'll see you next week. Don't be afraid to throw questions in Slack. Okay.
All right. Okay. Thank you.
Absolutely.
Bye, everyone. Mhm.
Bye. This number right here.
Have a good one,
guys,
Stan.
Yeah, this number right here is the number you're using to get your 35%. All right, and this trips people up all the time. All right, I've seen people try to do 35% of the width of the spread, which would be $5. Okay, that's not what we're doing. I've also seen a lot of people do 35% of the debit paid. Well, in this case, that's going to give you less money. So that's not what we're doing either. All right, so don't get confused. The number you're interested in is your max profit number. And if they don't show that to you right away, the way to figure that out is to subtract the debit you paid from the width of the spread. So it's a $5 wide spread. I paid $2.36. $5 minus $2.36 equals $2.64. Therefore, $2.64 is my max profit. So 35% of that is your target. But you have to add that because we are buying options, right? So if I take this $2.64 and I multiply it by 0.35, something went wonky there. $2.64 times 0.35. 92 cents is the profit I'm looking to make on this trade. So I want to take this spread and sell it for 92 cents higher than it is right now, which means I have to add it to my debit. So that means my GTC order to close this trade would be a sell to close order on the spread for $3.28. And I'm going to put this whole formula in the notes. All right, so you can go through it step by step there.
That would be helpful. Thank you.
Yeah. Let me target formula. Now we're going to talk about this a lot more next week, but I'll throw it in here so you can start thinking about it, okay? Let me pull up the vertical spread management spreadsheet here and I'll grab that. All right, so that way you can just kind of follow along. All right, so let's use the numbers we just looked at so that it tracks with the video, okay? Max profit, example, $5 minus $2.36, because we're looking at a Macy's spread for which we're paying $2.36 equals $2.64. Okay, multiply the max profit, which is $2.64, by 0.35 to get a 35% target, which we said was 0.924. 0.924. Finally, add the target amount, which is 0.924, to the debit you paid, which is $2.36. GTC order of, what did we say? 328. All right, so those numbers in here should match the video example that we just did. And this is just the formula way of saying everything I just said. All right, so there, I threw that in there. But again, we're going to break this down in more detail next week. And we're going to do some practicing next week where we're just going to start picking stocks. We're going to pick a stock, pick a bias, and we're just going to start setting up credit spreads and debit spreads left and right. We're going to talk about what we want for premium. We're going to talk about whether it's expensive or not. We're going to go through all of that. And we're really going to lock these vertical spreads in at that point, because after that, in 2 weeks, we go on to a completely different strategy altogether. And so you'll want to be well-versed in vertical spreads by that point.
Okay, so review tonight's class, this morning's class, review yesterday's class, and be ready to do trades next week. And finish it up.
Yeah, so next week we're going to talk about, we're going to review how to set these up and review targets. We're also going to, but we're going to dive into management. What happens when these trades start losing? You know, what are our stops? What is our risk mitigation? What is our defense tactics? We're going to go into all of that next week.
Okay.
I
think that's where most of my questions are. So we're going to come.
I'm sure.
Yeah.
I am sure. Use a GTC order. Okay. All right. So I will post this video. I'll post the notes from yesterday's credit spread class, and I will post the notes from today's debit spread class.
Okay.
And then as you guys have questions, throw them into Slack and let's get a discussion going. Because if you're wondering something, obviously there's a good chance somebody else is as well.
Okay.
Let's do, we've got a little bit of time left here. Let's do a couple of examples just to really cement these debit spreads into our brain. What do you guys want to trade? Give me some tickers.
I've been looking at a company called BLK. I'm interested. With BlackRock.
Oh yeah. That's the largest hedge fund in the world.
Yeah.
Okay, let's take a look. All right, BLK. Let's. All right. So Sean, you've been looking at it. Are we going long or short on BLK here?
Short.
We want to short it. Okay, so that means we're going to do bear call spreads. We're going to do either a credit spread or a debit spread, but it's going to depend on what? What's going to determine which spread we're going to use?
The IV.
IV rank, yeah. IV rank's at 32.7 right now, so I would probably lean toward a credit spread, but just for the, well, we'll set both up. How about that? We'll set both up and just see what we get, okay? All right, so here we are on BLK. Did you have a chance to watch the recording yesterday, Alonzo?
No, not at all. I work long hours, so that didn't work.
All right, no worries. All right, so
not yet.
Okay, no worries. You're probably a little lost then, or are you kind of? Did you kind of catch up?
No, not really. A good buddy of mine took your course a long time ago, and he's always talking about it.
Oh yeah, who's that? I'm curious.
Do you know Vaughn?
Oh yeah.
Yeah. Vaughn is stuffing this down my throat all the time.
That's good. Yeah, Vaughn was in the first mentorship group I ever did.
Yep.
So,
he did tell me about that. So I was trading another way, and so he talks about this, and we always just kind of see which strategy makes sense. I did some of Tony's stuff a while ago, and I did some training somewhere else. So yeah, we do talk quite a bit.
That's awesome. Well, say hi to Vaughn for me. I get messages from him every now and then, so it's good to check in. Okay, so IV rank is 32.7, which means we're going to start with a credit spread. Okay. Now, which expiration am I choosing?
March 18th, since it's 58 days and fits into the 45-60 day period.
It's also the monthly, right?
And
so that's what we're going to do. All right. So since we're going to start with a credit spread, We're going to go right to the 30 delta. You said you wanted to short it, right? So we need to sell calls if we're going to be bearish. So I'm going to start by selling this 880 call here. Now this is interesting. There's only strikes every $10, which means the smallest trade you can do in here is a $10 wide spread. So if I sell a $10 wide spread for $3.33, which would be one third the width of the strikes, okay, that means that I'm going to have about $6.66 of risk on the other side. All right, so that's going to be 6% in a 10K account. Little bit pricey.
Yeah.
I mean, not impossible, but you probably want to be around 15 or 20K if you need to trade a $10 wide spread. But again, everybody has a different risk tolerance. In smaller accounts, you're going to have to risk more anyway, most of the time if you want to grow it. So that's just something to consider.
Okay.
All right, so let's put this spread on and see what we get. Right now at 880 by 890, I'm getting $3.05 to short BLK with a bear call spread or call credit spread. What do we think of that premium?
The premium $3, maximum loss is 7, and it's too low, isn't it?
It is a bit low, yes. Remember, when we're selling credit spreads, the rule of thumb is always 1/3 the width of the strikes. So since this is a $10 wide spread, I'm hoping for at least $3.33 or more.
Hey, Robert,
Yes.
when do you check for earnings? I did look to see that we're okay, but I didn't know if that was part of your steps. And also I see something about a D in Tastyworks. I didn't
D
know.
is dividends. Yeah.
Dividends. Okay, got it.
Dividends are not a concern unless you have short calls in the money. If
Okay,
you have
got it.
short calls in the money, dividends could be a concern, but we'll get into this a little bit next week in the management rules. That's one of the reasons why I'm out of every option spread trade 21 days before expiration. It avoids dividend risk, it avoids assignment risk. There's just a lot of ways to get around that stuff, and not holding options to expiration is one of the critical ways that I do that.
Got it.
Yeah. All right. Good questions. Yeah. Normally you would want to check for earnings. I don't see anything on here. What is
Earnings are April 14th.
Yep,
Okay.
April 14th.
Cool. Yeah. So we're good there. All right. So yeah, this $2.95 to $3 at the 31 delta is not good premium. So what would you guys do in this situation?
Pass.
There's three choices really. One option is to pass. Yep, you could certainly pass and go look for something else. What is another thing you could do here?
You can go 60 days.
Well, we're at 60 days.
Oh, is that the 60?
Yeah, this is 58 days to expiration in March.
Ah, okay.
Yeah, so I probably wouldn't move the expirations. That's not one of the options I would consider personally. Another thing you could do is you could try a debit spread instead. Because even though the IV rank is high, if the premium isn't really there because the market has a bunch of put skew in it right now because we're just going down all the time, although right now I think we're blowing up, you might get better prices on a debit spread instead. So you could try that. What's one more thing you could try before we move away from this trade?
If you can't pass on it and you're looking to do a debit spread or a credit spread, and the credit doesn't make sense, the third option is, I don't know, I'm lost. I mean, not lost.
Different strike.
Exactly, Alonzo. Yeah, you move the strikes.
Okay.
Yeah, that would be one more thing you could try, because remember, my cutoff is usually the 30 delta is where I start, but I don't have a problem adjusting. And my cutoff is usually like the 39 delta. I will not sell 40 delta or higher. That's essentially selling around or at the money. And there's no statistical advantage there, right? So, but the 35 delta, I might be okay with that. Now, what do you notice as we move into the 35 delta here?
You get better premium.
We're actually getting exactly the same. which is kind of because the markets are moving. This stock's probably going down right now, so these prices are going down. We were getting $3 for the 31 delta. Now we're only getting 290, and as we move into the 35 delta, we're only getting 295. So there's just not enough premium in here for me. If I wanted to short BLK, I'd have to do it as a debit spread. And then if I can't get prices that I like there, I'd have to pass. So let's try the debit spread, okay? Let's walk through our process. First thing I'm going to do is put the short strike on the line with the most extrinsic value, which is right here at the 840 strike. All right, so I'm just going to take this red sell line and I'm going to flip it over here, which is something you can only do in Tastyworks. But you'd have to start setting up a put spread here, all right? And then I'll flip this one over here as well. All right, so this is a $10 wide put debit spread, which is a bearish trade, because that's what we want to do on BLK. Sean wants to short it. We're going to go bearish. All right, so what do you guys think of this trade as you think through what we just talked about in our debit spread lesson? How does this look to you? It's a $10 wide spread. So what are the three things we're going to check for in terms of the math-based metrics?
The pop is above 50.
Yep, that's one.
Right. The theta is 0.483. I need glasses, Jesus.
No worries.
That's where you want it, right? So
We want a positive number for theta, absolutely. What's the last thing?
The amount you pay in reference to the width of the spread.
Well, yes, that is the fourth check. All right, I guess there's fourth checks really. There's three math-based checks, and then the fourth check is just a price check. The other thing that you want to check for in math-based trading is the extrinsic value. All right, we want a positive number there. And remember, if you're not in Tastyworks and you can't see that, you want to make sure that the extrinsic value number, which is this column here, is bigger on the short strike than it is on the long strike. Okay, so we're good there. And then, yes, Alonzo, you're correct. The last check is the price check. And what are we looking for here?
No more than 2/3 the width of the spread.
Half.
No more
so
than half.
when I'm buying a debit spread, I want it to be half the width of the spread or less.
Okay.
Yep. So this is a $10 wide spread, okay, because it's the 840 by 850. So what's half the width?
5.
Yeah, $5. So if this spread is cheaper than $5, we're good, right?
Right.
Yeah, so this is the trade. If I wanted to short BLK, I'm getting positive theta. I'm getting positive extrinsic value. I'm getting some nice pop. That's really high pop. And I'm paying less than half the width of the spread. This is how I would do it.
Right.
And that's the process.
Right. And
You guys good?
Yeah, this might start to make more sense. One of the things Jeremy had said in the past was the best time to do options is on Fridays. Do you follow that same rule as well? You get the best premium? No. Okay.
No, that's for day trading, my friend.
Okay.
Yeah. So if you trade expiring options on the day they expire, you can get some really crazy moves. And that's very, very useful in day trading weekly options or selling weekly expiration credit spreads, neither of which I do because they're not math-based.
Okay.
Well, that's not true. I do day trade weekly options. I shouldn't say things that are not true. I day trade weekly options, but they have nothing to do with math-based option trading. Everything in this class is all on a swing trade time frame, 1 to 3 weeks.
Okay. That's what we want to focus on.
Yeah, so I don't usually trade inside the same week that the options are expiring, which is where all of the crazy volatility is because of the gamma risk. All right, so that's what Jeremy is referring to, is the crazy moves you can get on expiration Fridays, but you're never going to be involved in that with these strategies because you're always going to be doing something 21 days to expiration, which will make more sense next week when we go through all of the management rules.
Okay.
Yeah, good question though. Alonzo, you good?
I am good to go. I'll go back and review yesterday.
Perfect. All right. I'll get this recording posted. I'll post the notes from both classes. You guys hit me up with questions as they come, okay?
Okay,
Will do.
thank you.
Absolutely. You guys have a good afternoon, and I will see you next time.
See you next
Okay,
week.
have a good one, guys.
Bye.
You too.